Hello, everyone. Welcome to today's session. Happy Thursday. We're going to start out with, I want to go over kind of the entire top-down approach. Top-down approach is when you're looking first at the big picture. You look at the 30,000 foot view, okay, the overall economy, the large patterns, what are currently happening with the economics of interest rates and everything that's happening. And that's the real big picture. And there's two real main tools on TradersPro to be able to utilize to help with that process. Number one is this long-term market timing signal here on this directional alert tabs. Now, this is not super helpful in the real short term. It's a really slow moving indicator, and that's why it helps out the 30,000 foot view. You think about, when you're cruising along and you're looking out the window of your plane and you see the ground moving down below you, it looks like it's moving quite slowly, even though you're moving along pretty quickly. So it's looking down and it's looking at this fast moving process just slows it way down, so you can get a little bit different perspective. Now, in that, what we're looking for is the edges. We're looking for the extremes, we're looking for the trend, and then we're looking for the extremes on the bottom as well. So currently this is where we've been working within this last year. This time frame up here, this upper chart is 1 year, this bottom one is 20 years. So this is only capturing this move here, and you can barely see it getting cut off now, is this green bar right here. When that crosses over, when this crosses back up above the zero line, then you get a trend shift. So when those trends are moving, we want to be aware, but when the trends start to get extended towards the upper end of the range, then we need to be paying attention, because those trends can start to shift. And this has been an interesting 3 months now, 4 months now, going on this entire year, where markets have kind of been consolidating sideways, and we haven't had a lot of ups and well, we have had ups and downs, but really nothing continuing to the upside. That's a lot of the stocks that we're looking for. Momentum type style trades are not breaking out, they're not continuing, and that's just a condition of a market retracement. So that big picture, when we're looking at this, and we've been talking about it for quite a while now, this rank of the bull market, the rank of the bull market is at 21.34. That represents this line that's up here. And that, as I've mentioned for a few months now, this is as high as it's ever been in the last, it's been this high, I think, 3 times in the last 20 years. So it's a significant rally. You can see it on the price chart. You can see the S&P 500 has had this big run up. Now, every time we get a big run up, we get some kind of a retracement, whether it's a deeper retracement, whether it's a shorter retracement, whether it's a COVID retracement like we've had here. They happen. They just happen. It's just the nature of trading stocks. So what we want to be able to position ourselves in doing in owning equities is mitigating the risk and understanding where the major risks lie. And the major risks start to lie at the extremes. Okay, the extremes being this upper level, the probability of a retracement and then more upside when charts start to look like this. Okay, it's really hard for them to go here and then to go here and then to go here without giving one of these first. Okay, and then it can stabilize, and then it can start to move back up. So this parabolic state, when stocks or markets or anything, gets to that extreme, parabolic. And when I say parabolic, it's just this move higher, this parabola of price moving higher. It's just, and we get to this level and we think, nothing's going to change, the stock's not going to fall, or we start spending the money in the brokerage account before the trade is even closed out. Okay, and so our mentality can really throw us off here, especially where we've had a really nice run. A lot of the trades just work. Uptrends are typically pretty easy, and momentum trading works really well. When we're at these market tops, nothing works, okay? So other than sitting in cash or trading really short term, or even trying to go the other direction. The hard part about trying to pick the top and go in the other direction is we're still in a really strong uptrend. We're still in a really big bull market right here. So trying to pick a top is a little bit harder. Now, we can do that by allocation changes, and we've done that. I'll just jump over to the portfolio here, because it's a good representation of kind of the amount of risk that the portfolio is willing to withstand right now. And that's only about 30% in equities and 60% roughly in cash, somewhere around those in those the word just left me, allocation size for each individual equity. Okay, so from there, we're definitely getting volatility even in some of these holdings. Doesn't matter if they're defensive holdings. We're starting to see gold start to work back here today. That has continued to work. We've seen a few that are continuing to work, but we've seen a lot that have just kind of been floundering, kind of flat up and down and not really moving, and really nothing real exciting to that overall uptrend. Okay, that upside, that's a situation or a result of the market pulling back right here. Okay, so we've got two things happening now. So that's the big picture. The big picture is we're at the top of the trend. There's a high probability of either no move or a sideways move or a downward move in equities. So am I positioned in a way that I'm comfortable with that amount of volatility? The only way to do that is, and we've talked about this and we will continue to talk about this each week, is cash levels and holding levels. Okay, this is for us, a position trading time frame where our holdings are usually anywhere from a week to 2 months in length, maybe a little bit longer, 3 months if we really get a real nice trend. But for the most part, it's a couple weeks on the short end, or even shorter than that, a few days if a stock immediately reverses, or moving into a little bit longer time frame into the 2-month range. If your time frame is a year or 2 or 3 or 4 for holding a stock, then TradersPro is going to create a lot of volatility for you, because you're going to get stopped out of trades. They're going to have volatility. So in order to remedy that, it is, what system am I following? How much? What is my position, my allocation size going into the trade? Where are my stop loss? And how big of a size or how many positions am I actually taking on? And in what environment? Yeah, you may say that, and one of the things that I do suggest is when buy-sell ratio is red like this, when we have buy-sell ratio that's less than 1, you could either, if you're very conservative, not take on any new trades at all. Okay, and now that's been a little bit tougher through this phase right here, because we did still have a few trades that were working, but we had a lot of choppiness. It went bearish and then it went bullish. But in this case, we're at the upper end of that range. We know that we're heavily to the bearish side. We're moving higher. We've got a lot of economic issues. We also have the bond yield curve. Now, the 30,000 foot view, let me go back to that. These are your two tools. That is your upper range of the long-term trend and your bond yield curve. We've talked about this before as well. Bond yield curves are interest rate. It's just a line representation of interest rates. This is the 3-month interest rate. This is a 30-year interest rate. The 3 months paying more than the 30-year. That typically means that the Fed's trying to slow down the economy for some reason or another. Typically it's inflation, and that's what's happening now. Inflation is too high, and so the Fed's keeping interest rates on the short end of the yield curve higher because they need that to slow the economy. They need it to slow down monetary policy, so companies and consumers' ability to spend money or borrow money, I should say, or to be able to borrow to get a mortgage, to be able to borrow to get a car, to be able to borrow to grow their business, to be able to borrow to take a home equity line out. Those things, that they're very expensive right now because interest rates are so high to borrow money in the short term. In the long term, okay, well, I should say even in the short term, it's even the interest rates have made it more compelling to have your money in shorter term duration assets. Okay, a shorter term duration asset like a savings account, like cash, like a money market. The interest rates are incentivizing us to have our money there right now. They're not incentivizing us to have our money in long-term assets like equities. Okay, and so ultimately, I think that equities are going to pull back because of this yield curve. It typically takes 18 to 24 months for that to show up in the economy. Almost always it creates a recession. It's happened back here. We had inverted yield curve, but these inverted yield curves can last for years too. So it's not really a fast signal. It's very, very slow signal, but it does take time. And once that starts to happen and the market starts to move back down again, then this is what happens. You can see up here as stocks are moving down, bond yields are moving down. That happened once in 07, in 2000, happened again in 2007. You had this inverted curve. The stock market collapsed. The economy fell. Federal Reserve could lower interest rates again. Okay, so now we've just been working. We had low interest rates during COVID, like really low. All these were almost zero, and even the long end of that curve. So now we're sitting right here. We're at an inverted yield curve with high interest rates, and we saw a GDP number that was not very good this morning. We saw Meta's numbers. We saw Tesla. There's some issues happening right here. So this is just that quick way to be able to say, and it's not a quick signal, like I say, but it's a quick way to glance at what is the economic conditions. And if you see an inverted yield curve, you should immediately know you've got some kind of issue economically, and the Fed's trying to slow it down. And slowing down the economy means a stock market that is going to come back down again. Okay, that stocks are following the anticipated earnings of companies, and if those anticipated earnings are expected to flatline or come down, then there's bigger issues. Now, the other factor in that is technologies, new technologies, and we dealt with that right back here. Internet. This was really not a tech boom, but it was more of a debt boom, subprime loans, and the ability to, borrow just a sick amount of money with no proof of income. There was a ton of borrowing happening there. There was a ton of money that flooded the system during COVID. We'll see what happens right here. If it's AI that creates more productivity, that's the kind of the buzz. I don't think it's going to happen. Just like everything else doesn't happen. Crypto didn't pan out. .com didn't pan out, at least in the first move, and then it collapsed. Okay, .com collapsed, and then it builds from there. Cryptos have collapsed. They're building from there. Stocks, not that they're going to collapse, but they are priced to perfection at this point. That's the real big picture. And then we move in from there. Then we move into some of the shorter term indicators, like the buy sell ratio. These are shorter term, meaning this is just this month. So this month we've got a widening of that buy sell ratio, meaning that we've got a lot more sells in the database, stocks that are moving down than we do stocks that are moving up. Well, that's what a market is. The market is all of these stocks combined. So if the market as a whole, if all of these stocks, the vast majority of these stocks, if 2,000 of these are in downtrends and 800 are in uptrends, that's a heavy weighted trend to the downside. That does show up as well in our equity indices like S&P 500. So S&P 500, we've retraced back down. Okay, we're in this red zone. We're finding support at the momentum zone. It works just like stocks and as it does with markets. Okay, we get a retracement. It's going to react around the prior areas where it was a support, and it's going to act around Fibonacci support areas as well. If we break through and slide down, and it's nice that we're seeing a little bit of a recovery here today. Let me change that signal back over so we can see. You can see this is this white bar right here. It's moved, it opened lower, and now we're bouncing, and now we're rallying back up. We'll see if we can hold that because it was down pretty good. I think Meta's news, it was down 15% this morning. And so if we can rally, if we can gap, and if we can find some support, we may go back up and test these areas. But now we have an issue. We've got an issue of we're on the underside now of a pretty significant range, this 506 range. Okay, this 506, when I say 506, I'm just talking about this price of SPY right here. So we've got resistance now. That hasn't happened in this entire trend. Now, for the first time, we have a resistance area in major markets. Now we've got to see if they hold up. If they don't hold up and we get resistance here, and then we get some more bars that go red and look like this, if it rallies back up and we can't break that, we get some red bars, then I think we're in for some continued sliding. This could also be a 5-wave. Counter trends can happen in 3 or 5 waves. We're more interested in the support and resistance areas than we are a wave count, but in terms of what they typically do, It could easily slide. It could rally up. There's just some work to do. Okay, and this is also telling us that there's some work to do. We've got a long-term uptrend. Okay, but everything else is short-term. What does that mean for you? Okay, what does that mean for your retirement? What does that mean for your assets, long-term and short-term? That's the biggest decision that you've got to decide on, is what percentage of my account or my assets am I allocated, and how am I allocating those? Am I in individual equities like we're doing? Am I in ETFs? Am I in whatever? What is it that I'm comfortable trading? How is it that I'm comfortable trading? Would I rather just own and every single time we get these retracements, we're going to get individual stocks that they're just volatile. They just are. So understand that, but then also be okay with what is my acceptable range. Okay, so here we've pulled back about 6% so far this year. It's been relatively flat. We had a big, nice run up when the market was moving higher. Now it's kind of pausing and moving to the side and then down slightly. So our risk at this point, having about 15 or 16 holdings, is, we'll still end up with a few percentage points up and down per day, just like the market as a whole. But we've got significantly less risk because we only have a few holdings versus everything invested right now into equities full steam ahead. Now you can also use this, as I mentioned. I know some of you have longer term retirement accounts like 401k plans and things like that. This can also be a way for you to change or rebalance the allocation as you get different moves here as well. Market trend, for example, we're at the upper end of the range. It's been a long, year and a half rally. Could we retrace? Probably so. How much volatility? What's my percentage in equities? Is it 50%? Is it 80%? What do I need to change that to be okay with some anticipated volatility going forward? And that anticipated volatility could look like this. It could be worse than that. It could be less worse than that. Okay, 481 right here is a support level that we could see a bounce at. It's going to be an interesting few weeks right here, and it's very prudent right here to have a larger amount of cash on hand. And then still, we're going to get some individual stocks that continue to work. We're going to get some moves higher and lower, and that's what we'll continue to look for. Now, we're looking at muscle stocks. We're continuing to look for these stocks that are in this upper momentum zone. Let me switch back to signals like Lifeway. Hey, Lifeway that's continuing to move higher. We are seeing stocks to food stock, dairy, eggs, butter, I believe, and there are some other names in there that are starting to show up. We're continuing to see banks. Which is an interesting trade on banks. Also, energy. We're still seeing oil elevated, and a lot of these energy stocks are still going to start to pop up. So interesting when we have a big day that we get more. There on a down day we get maybe 20, 15, if that. On an up day we can get, it usually fills the basket, and with some options, okay, some options to look at to add into a portfolio. Now, what I mean by that is I've still got to decide, right? I've still got to choose which one of these, if any, I'm going to buy, and is now a good time to buy. If I'm a really conservative trader and investor, I've got to look at this and say we're elevated. I've got to look at buy-sell ratio and say we're less than 1, and I'm not buying anything new right now. Okay, that's one strategy. That's the most conservative strategy because things can always get worse. Okay, if you look at where we were at here, and here you get the uptrend, you get the downtrend. We had that much more downside to come. And typically, not always, but typically this is not a one and done deal where it immediately does once and then reverses. We usually get 2 or 3 of these. So if that possibility of downside is stressful, it's not even that. It shouldn't be stressful because we should be allocated properly to deal with that stress. Okay? And stress in trading is essentially what's a worst case scenario? What could I live with? What could I deal with? What do I want? And then how am I approaching that going forward? And just holding on to stocks and then waiting for them to bounce that, that's a longer term strategy, and that's 100% fine as long as that allocation and risk is appropriate for what you're trying to do, what your goals are. Okay. Let's see, let me jump over here. So that's the kind of the long-term perspective. We're looking at the big picture. We're looking at bond yield curve for really that underlying economic indicator. There's a million things you can add, but I try and just keep it as simple as possible so that we are focused on just a few things. And those few things that we focus on give us enough information to be able to make some decisions. We don't have to have, flashy screens and a million charts and screens and everything happening all at once. That's overkill for this methodology, and we just need to keep it simple, and we need to look for what's working. We need to look where market conditions are at, and then we need to manage our risk going forward, and we need to create a structure and a plan so that we're following them. And all of that is in the Learning Center. And TradersPro, if you've got this, you've got the Learning Center, everything is in there as far as trainings, and you've got you've got your books that are in here. The trading guide, how to make money in stocks, how to make money trading stocks. This is quite comprehensive. I wrote it about 10 years ago, but I've updated it recently. It's all the same. So if you need a little bit of a checklist, and go back through and watch to see, where is that? It's not loading. There it goes. So time frames and signals, dealing with your setups. Okay, what are you looking for? There's a little bit more of a checklist in there. There's also you've also got access to trading plans. Where did I put that? Right here. 4 simple steps and trading plan. Okay, that trading plan, this plan doc here. There's one so you can go through why am I trading? What is my approach? What are my goals? What are my objectives? Okay, what markets am I going to trade? What are my setups? I'm doing new buys. All trends are up, 98 rank or higher. Buy, sell. Create that plan. Go through, and there's one of these that you can actually print out. And let's see, I think it's this one right there. That's an actual Google Doc here as well. So then you can download it and edit it if you need to there. And that's really, really important to create your plan so that as you're entering into new trades, okay, I could say, what are my setups? I'm going to scan for the following 2 trade setups. Buy sell ratio is above 1. New buys, all trends 98 rank or higher. Buy signal, stocks that are not extreme. Okay, so if I have a scan and I'm looking for stocks that are not extreme, I could go here, I go into my screener, and I actually have somewhere in here 95 to 100 not extreme. Okay, so this is going to pull in some of these stocks. 99, 100, they're ranked, they're uptrend, they're not extreme. Not extreme means they're not in this upper range. So they've had really strong uptrends here, but they're not extreme all the way up to typically, we get it's okay to buy in that range, but it typically pulls back, and you may get a little bit better buy price. But even if it is extreme, sometimes that's okay. But if in your trading plan, you're saying, I don't want to trade anything that's extreme, okay, or, and I'm not going to trade anything unless I have a buy sell ratio that's greater than 1. You can add the different criteria and the different processes for whatever it is that you feel comfortable with, and then you can implement TradersPro system to your own risk tolerance. Okay, so there's a trading plan in there as well. Entry rules, all orders will be limit orders at the ask price, or all the orders will be limit orders with the market price. That's typically, a lot of cases what we'll do is put on a market or put on just a limit price, a limit order, and as soon as that market opens and that limit price is under the limit, it'll immediately fill and have a market order. Okay, so make sure those rules are in place, and then just follow them, and then just follow those rules. You're gonna, not every day is going to be different. You're going to have some up days, some down days, but if you're consistently following your rules, particularly on the risk side of things, so that your stop losses are managed. And we talked about this again last week, but I'll go over it. It's one quick way to manage your risk is clicking on this portfolio tool, and then saying, okay, if I were to buy X amount of shares, 100 shares of this stock at $20, that's 2% of my 100. If I placed a stop down here at, let's just say 18, below all of that activity there, then I'm saying I'm willing to allow this amount of volatility in this trade, okay, until here. At this point, I will have lost $350 based on 100 shares and a $100,000 account. Okay, if that's too high, that's too much risk for the portfolio I want to build, then I have to change one of these two numbers, right? I've got to change the 100. Maybe I change that down. Maybe I want to cut that in half. So I go to 50. That cuts my risk in half, but it also cuts my position size in half. My stop's the same at 18, but now I've got 1% allocated instead of 2%. That 1% allocated is $1,000, okay, and that's the entire position. 50 shares at 20 bucks a piece is $1,000. If this stock dropped to zero, if it went from here, to 10, or even worse, down to zero, that's not going to happen, not on a stock, at least not overnight. It can happen over time. But if that did, now I know my worst case scenario. I don't want to, that's not going to happen. I mean, it could, and that would be the worst case scenario. Well, what does that do? Well, I'm going to lose 1% of my trading account. Is that okay? And obviously we're going to have a stop in place first. Now that stop, we want to have it wide enough that it allows for the volatility, but we want to have it close enough that we're not losing. We're not in a loser for very long. Okay, if we set it at 18, in this case 18, it shouldn't get back here. Okay, if it does, if it gets back here and lower, we've had a lot of scenarios where we've had them come back, touch this area, stop us out, and then move higher. Those are frustrating, but I have to manage my risk. I have to follow those rules. If that keeps happening, change your rule a little bit, or change your allocation. So it's like, okay, I'm going to go wider stop. If I'm going to go a really wide stop, I've got to go small position size. Or maybe you're going to say, bag the stop loss. I don't care if the stock is volatile, and I don't even care if it retraces back down by 20 or 30%, or okay, I'm not going to have a stop loss at all. And then I'm just going to eyeball it and say, okay, I know that if I'm down 20 or 30%, or if this signal changes to hold and then back to sell, then maybe I do sell it, but I'm not going to have a stop loss at all. If you don't use the stop loss at all, you've got to have a small enough position size that that volatility doesn't matter. And that actually is not a bad way to trade as well. Not having a stop loss, but having a lot smaller position size, as long as you're still using an exit strategy, right? We don't want to still just wait and ride it out. You'd still want to sell on a sell signal. You'd still want to have some type of an area that you'd say, okay, this thing's a dog. I don't want it anymore. I'm out. Okay. So a couple of quick ideas for you as far as allocation. That really is the name of the game. Is you're deciding what is the market doing? The stock market is moving higher. Is there a chance for me to continue to profit in this market? Yes or no. From there, I've got to look at my short-term signals and say, okay, short-term, yes, we're in a long-term uptrend, but we're now bearish in that uptrend. And that's what also direction alerts is going to give you, that mildly bearish in that uptrend. And part of that is, we look at sectors and say these sectors they're all, if some hold, some sell, some buy, that's bearish. Okay, so we're getting confirmation across other indices as well. That long-term, that big picture, and then we can zoom in and say, well, which stocks do I want to participate in? S&P 500's got 91 stocks in uptrends. Maybe I focus on some of those there as well. I've got Capital One Financial, is working, continue to move higher. Maybe I focus on a stock like that during this situation, this bear market, or not bear market, but this retracement we're dealing with, whatever it turns out to be. And I'm only going to choose a certain stock, certain criteria, certain stop loss. Okay, set those up for yourself so that you're comfortable with some of those numbers. I'm going to end on that note. I sure appreciate everyone's time and effort, and we'll see you next time. Thanks a lot. Bye now.